All right, my friends, I want to revisit the idea of portfolio declines and how portfolio declines hurt a hell of a lot more worse than I think a lot of people are understanding, especially those who are pretty close to being able to or being having to pull money from their portfolios. And if you think about it like this, man, I don't care if you're that close to retirement or not. I just, if you don't have some kind of liquid asset to pull money to pay the bills, and you're relying on your income from employment, self-employment, anything like that, that you could be running into a buzzsaw. And I always think about it like this. I'll never forget my branch office manager when I was at Legg Mason as a broker. He was getting paid a salary from Legg Mason. He was getting paid commissions based on investing assets, and he was getting stock options as well from Legg Mason. So he bought this property in Smith Mountain Lake. I'll never forget this. And he leveraged his stock options against the property in Smith Mountain Lake to buy it. So that's what he did. He basically he margined essentially. All right, so Legg Mason stock looked good, a good dividend, high value stock, blah blah blah. So he leveraged that to get cash out to buy a property in Smith Mountain Lake in Virginia. The market just falls off a cliff. The stock falls off a cliff. He gets a margin call. His investments that he's making money on investments, people are pulling out of the market. People's investment accounts are going down. People are getting scared. That falls off a cliff. On top of that, there's a lot of consolidation in the business. It's no longer Legg Mason. It became Smith Barney. Then it became Wachovia. It became Smith Barney, something, Wachovia, and now it's Wells Fargo. So your job potentially is at risk, if that makes sense. All because of your exuberance of the stock market. I hate to even say that exuberance word. It's not irrational exuberance out of Greenspan. But let's just say, okay, I got $100,000 in my portfolio today, and now it's worth $500,000 a few years later. We'll just say that. That's what you expect. And your job is heavy contingent on just the capital markets, for whatever reason. You know what I'm saying? I don't care. It doesn't mean you have to be in this business. It just means at the end of the day, you're making income for whatever reason. Not even heavily contingent on the capital markets. It's more like you have income coming in that looks pretty steady until it's not. All right, so now the market gets killed out of 2001 and 2, but more likely 2007, 8, 9. I don't mean more likely at predicting that, but that's more of a painful because it's all encompassing. Now companies are in complete panic layoff mode. And this is what happened to me in 2007 and 8 and going into 2009. Complete panic layoff mode. Thankfully, I was able to land a good job at USA, but all my loans were called in, man. USA, they relinquished or they reneged on their home equity line of credit. They said, "Oh no, I was the whole thing," and my credit was fine. I was paying my bills. They did this for everybody. They said, "We're not going to give you terms anymore." And you're like, "Well, I was using that for my emergency fund." They said, "No more." My credit card had what I thought was 0% balance transfer fees, not 0% anymore because there's fine ink that said they could change it if the situation dictated. I was like, "Holy crap." The dividends were cut to a penny just to make sure they could make sure the preferred shareholders got paid. So if you're relying on dividends, never mind the stock price, your freaking goose is cooked. And so that's my concern. So I sit there and I say, okay, I'm not saying you have to freaking get nervous, and I'm certainly not saying it's inflationary because I don't think it is. I'm just saying, what are the contingencies out there that are of a concern, and how do you deal with these contingencies? It doesn't mean I'm freaking. I don't. I see some of these comments. I'm like, I'm not saying I'm getting. I don't get it. I'm just saying, I'm trying to forestall a contingency or incorporate a contingency that says I cannot get swamped like I was in 2007 and 8. I can't be my branch office manager in 2007 and 8. Now, he survived, but he got lucky, man. He got lucky because the markets did come back strong. But let's check this out. So we're going to show you this spreadsheet here. All right, we're going to go back to 1973. Oh, I guess and hopefully you didn't see what that just said because it's a surprise. In 1973 and 1974, this investment was down 17 and 10%. Sound like anything you know? 17 and 10% declines? 37%? Sound like anything? Ironically, inflation was at 11 and 23%. So remember they say stocks are a hedge against inflation. Not in 1973 and 74. Not in 1973 and 74, they weren't. All right. And so now we start seeing the interest rates drop, the inflation rates drop, and the interest rates did the same. And from 1975 all the way on to 1989, we were making bank, man. We're up. The 15 years from 1975 to the end of 1989, we were up 14 of those years with only one small down year. All right, so I hope you're hearing me so far. This is the Nikkei, by the way. All right, this is the Japanese index. And so what we're going to do is we're going to start with $100,000 in 1975. All right, because I want to show you how painful this can be. And we see that we have lower and lower and lower inflation until we have 1%, 10 basis points inflation, 60 basis points, 70 basis points inflation. Not much inflation and high rates of return. High inflation, we saw it before, low rates of return. It's just, the reason I want to point that out is because inflation doesn't indicate anything that the stock market can do. All these people say, if we have inflation, the stock market's a hedge. It's simply, there's no evidence of that, man. None. In fact, if anything, inflation smokes the stock market too. We really only have one instance of inflation in the United States. And when that happened, the stock market got crunched, the 60s, 70s, and into the early 80s. We have multiple instances of deflation, and generally speaking, deflation was very favorable to stocks. Now, it did not happen. Well, I'm going to share with you what happened in Japan, which could easily happen here. But you can't say inflation or deflation leads to this in stocks. There's just no evidence of that. So don't use the stocks are hedged against inflation argument. It doesn't fly here. There's no evidence of that. Doesn't mean it can't happen, but just there's no evidence historically that is likely to happen. All right. So we start with $100,000 in the Nikkei in 1975. By the end of 1989, we're worth $1 million, a million schmackes, right? Not too shabby. We had one down year. That was it. How many people in 1989, at the end of 1989, were sitting there saying, I got to take some gains off the table? None, because inflation was still yet. I mean, look, inflation went from 0.1 to 0.7 to 2.3, I should say. That's a pretty significant increase in inflation, isn't it? Huh. Now what happened after that? Went to 3.3, huge inflation. So the numbers start falling across a little bit. So now $1 million, and now 598. Just 2 bad years. Took 40% of your capital. 2 bad years. That's it. 1993, inflation starts going down again. So we get a good up year. So now, but 1992, we had another down year, even though inflation dropped from basically by half. So our portfolio is at 441. Inflation keeps going down. What's our portfolio at right there? 1998, $360,000. And look at that. Hardly any inflation, low inflation. And yet the portfolio is still getting hammered. So during high inflation, the portfolio got hammered. During lower inflation, portfolio got hammered. During deflation, portfolio got hammered. So by the time 2002 rolled around, you're at $223,000. Not too good, man. All right, so now you're like, all right, we're back on our feet here. All right, so by the time 2008 rolled around, you're at $30,000. You had $1 million in 1990. You had $230,000 20 years later, and that's without taking any money out. That's without taking any money out. So you can see right here, man, your goose is cooked. If you start taking money out, we'll just do a simple, and I say 5% a year. We'll show you what we're looking at here, and adjusting for inflation. So you're taking $5,000 a year out. You're adjusting it with inflation. Am I doing it every year? Inflation adjusted, 5,000. Hold on just a second. I want to make sure that's all right. So if you're taking 5,000 a year out, by the time 1990 rolled around, you got $509,000 in there. So you're still $500,000 after taking 15 years at 5,000 a year out, adjusted for inflation. And by the end of 1990, 89, you're taking 9,000 out. Not too shabby. However, by the time 2003 rolls around, or 2008 rolls around, your goose is cooked. So that's not even a 30-year retirement. All right, so you're done. You're done. That's if you started in 19. So you were you put. I tell you, let's do like this instead. What we'll do is we'll say we had $1 million. Yeah, I tell you what we'll do. We'll go. Hold on just a second. We had $1 million by the time. So 1975, to 2008, that was a pretty good retirement because those first 15 years are very good to you. The next 15 years, you're done though. I mean, you literally ran out of money, but that's okay because you probably did okay because you survived those first 15. All right, but let's say we're going into retirement. We got $1 million. All right, remember we started with $100,000. We invested from 1975 until the end of 1989. So now we got $1 million in. And now we're going to start in 1990, and we're taking $5,000 a year out, 5%. All right, and we're adjusting that with inflation. All right, so we're going to start that. Let's see what that looks like there. And remember, we started with $1 million. After the first year, we're down to $600,000. We lost $40,000. By year 3, we're down to $421,000. You think you're doing okay there? You think you're hanging the course? By year 10, right here, we're down to $229,000. Yeesh. Now we come back around. We didn't make it, but man, it got dicey there. Look, 181, yeesh, 163. And the only reason because we had the deflation. And we did come back around. We still had money. If we could survive, we still had money. But man, it was tough. It was tight. It was tight. That's at 5% a year, inflation adjusted. The only thing that saved us was the fact that there was no inflation in Japan. None. I'm just telling you, how many people were sitting right there in 2008? This is after they've been retired for 18 years saying, I got $163,000. I'm only 78 years old. Yeesh, that's a tough. Now, at the end of the day, I don't think you're going to take 5% a year adjusted with inflation. What I'm saying is, that's tough, man. That's tough right there. Now, you did survive. So, I mean, by the time 2020 rolled around, you're at 889. So you're able to survive that, which is good. But man alive, there's some tough times there. All right, so now I want to go and show you what we're looking at, the S&P 500. All right, so remember Japan, 1975 to 1989, you had $1 million in your portfolio. In the S&P 500, 2009 to 2021, we got how much we got in there? We got 419,000 in your portfolio. All right, and we've had, look at this. This is the S&P 500 in red. Up, 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 down, up, up, up. So we've had, let's see. That's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 years, 12 are up. 13 years, 12 are up. All right, so you can see where I'm going with that. Now, I want to show you something else, too. Actually, I'll show you. Let's go back here. We'll go to 1982 in the S&P 500. I guess I can't go back that far, so we'll do it here. 1982. We'll get rid of Nikkei. We'll just go to the S&P. There we go. Just go to the S&P 500. 1982. And my premise is, watch this. S&P 500 right here. 1982. That's 1989. That's 1990, right? Yeah, 1990. Up, up. I mean, it's almost identical to Japan until 2001 and 2. Look at that, man. 1982 to 1989. You had 18 years and only one down year. And then you went to the chaos of the aughts. All right, so by the time 2009 rolled around, you're at even Steven. Then you had the great decade from 2009 to 2021. I just find that to be some similarities there. The Japanese with the U.S. economy from 1982 to 1989, serious runs. Then aughts came around, and now we're back at serious runs. Anyway, that is my point. It doesn't mean I'm sitting there thinking, oh my goodness, we're all going to, I don't know, but it just seems to me if retirement is contingent on, and not just retirement, if your ability to pay the bills is contingent on you needing to have access to your portfolio, don't you need to protect some of that? Don't you say, look, the gains have happened. They might continue on, but I need to get some more money on the side where I have some stability just in case, if that makes sense. I think you do. I'm doing that. I think you do. And again, you take the gains, man. Take the gains. Because the gains are fleeting. And then you start dipping in your principal. You're like, man, I'm telling you. Some guy posted on my YouTube channel yesterday. He goes, oh, man, I missed out on millions of dollars because he wasn't in the market. Or he said, I lost millions of dollars by not being in the market. You didn't lose any money by not being in the market. You just missed, it's called an opportunity cost. Well, now you don't jump back in full throttle because you think you've got to get, it's fear of missing out. I mean, those days are gone now. So now what do you do to protect yourself? And again, what I think is start taking some gains off the table, man. And that's what I'm looking at. I'm looking at real estate investment trust, Vanguard tips, I bonds. I do another video. My man, I think Mike sent me a video on the difference between I bonds and tips. Very interesting. I'll do a video on that next. But I just tell you, man, what goes up will come down at some point, and don't just get caught in this thing like the stock market. The evidence shows that we're going to be okay, or the Fed's print. I don't even care about that. The Fed's been printing money since the 1920s, man, 1930s at least. I mean, come on. It's not the Fed's printing money. My goodness. Yes, they are inflating asset. I get all that. But it's not like the Fed is what caused in 1982 to 1999, even though that's what they said back then, too. It's not the Fed that was causing Japanese, because there was no growth in the Japanese market, and yet the Fed was printing money like crazy. That's why their debt to GDP is at 240%. Anyway, so you take the gains when you can, and you say, okay, I'm going to lock these puppies in. I'm just telling you. I think it's something you should be thinking about. All right, we'll see you.